So in Chapter 4, Preventing Fraud. So a lot of the things in Chapter 4 we've discussed before, so we'll try and go through fairly quickly. But the learning objective is how to create a culture of honesty, openness, and assistance. We've talked a little bit about that already. Know how to eliminate opportunities for fraud through internal controls and other things. We'll talk about those. Understand how to create an effective organization to minimize fraud, so how to prevent it. And then talk a little bit about proactive fraud auditing, which we'll spend a lot of time talking about later on. And understand the importance of creating a comprehensive approach to fighting fraud. So like I said, a lot of these things we've discussed. So we'll go through them fairly quickly. Now the first is creating an organizational culture that that discourages fraud. So obviously hiring honest employees and providing fraud awareness training, providing a positive work environment, and then potentially offering employee assistance programs. And what we've seen is that studies indicate that 30% of Americans are dishonest. So roughly a third of the country is going to be dishonest. And it's not going to have a problem lying. 40% are situationally honest, which essentially means that they're generally honest. There could be situations where they don't tell the truth. And then about a third of the people tell the truth all the time. Right? So how do we get people into our company, or the people that tell the truth all the time? And those are rough numbers. I'm not sure it's exactly like that, and probably everybody's a little bit situationally honest, but we'll go with those numbers for now. So the first part is hiring honest people, and that goes back to verifying the applicant's resume. And the book gives a lot of examples, and you can probably remember a lot of examples where people have fabricated their resume and then wound up being fired. They show the example of the CEO at Radio Shack who said he had college degrees that he really didn't have. You know, there was a former football coach at University of Notre Dame, didn't coach there, didn't even get to coach a football year because they discovered discrepancies on his resume. And so obviously the thinking is that if somebody's willing to lie on their resume, then they're willing to potentially cheat at work. So verifying the references on their resume, an applicant's resume, following up on their work history, then also training the people who interview to be skillful in their interviewing and potential to look for dishonest behavior. And then, use other approaches as appropriate. I mean, we've talked about using honesty tests and other things to make sure that you bring the right type of people into your organization. It's primarily looking at that resume and following up on references, because the last thing you want to do is to hire somebody who's committed fraud in another organization. Now, the other thing when they come in is you should provide fraud awareness training. So creating the expectation that they'll get caught if they commit fraud, and that fraud is actually not a part of the company's operating procedures, and following internal controls. So setting that expectation is really the key. So you need to train your employees on how costly fraud is, the effects of fraud, on your company. Then make it clear through your policy statements that you're not going to tolerate fraud, and that you do take swift action, but fair if fraud, if you suspect fraud. Right. So if your employees know, they've been trained when they came in, what the company's policies are, that you're not going to tolerate fraud, and that you have a history of going after people who commit fraud, who violate the rules, and you take action when appropriate, you're going to set the work environment that fraud's not okay, and it's going to be extremely difficult for employees to rationalize that it's okay to commit fraud. And not only that, you need to create this positive work environment. So we've talked about having a code of conduct and conveying expectations to others. So having a company policy and a kind of formal code of conduct that employees have to sign helps them, when they come in, recognize, okay, this is what the company expects, this is the tone that they're setting, and helps keep honest people honest, right? They can't rationalize that, okay, well, padding my expense account is just part of the job and everybody does it, and so it's okay. So that's the first step. Then you also want to have an open door policy where people feel like they can come in, they can talk to their bosses, et cetera, and like they're being listened to. Because what causes people to rationalize fraud is like, nobody's listening to me. They get frustrated. It's okay steal from the company because I'm not being heard. I'm frustrated, like Walt Pavlov. So to the extent that you can go into your boss, you can get access to management, that they'll listen to you, they understand your complaints, right? It creates an environment where you feel like people are listening to you, you feel like you're a part of the firm, and you have positive attitudes towards the firm, and it makes you less likely to rationalize bad behavior. Now, also, as part of setting up a positive work environment, is you need to set expectations, right? If you set expectations that employees will perform, that they're not going to violate internal controls, that they're going to follow the code of conduct, and you create a sense of ownership in the company for all the employees, then they're not likely to steal from you. And the Pygmalion effect is that you're going to get the behavior of your employees that you expect. So if you expect that everybody's going to steal, if you expect that everybody's dishonest, then they're likely to do that because you're going to create a positive work environment and people are going to perform according to expectations. But if you are positive and you create a positive work environment and you expect that people are going to follow the rules and that you've appropriately compensated and recognized people for the work that they're putting in, then it creates affection for the company, a sense of ownership, and people don't tend to violate the rules. Like we said with the Walt Pavlov case, he was extremely frustrated with his boss. Doesn't feel like they were listening to him, and they set the expectation that the most important thing are profits and earnings, and that's what they got was fraudulent financial reporting. They also got frustrated employees who committed fraud. The other thing is setting up a code of conduct. Sarbanes-Oxley requires that every company have a formal code of conduct, and that the SEC also requires that of their employees. And by creating that formal code of conduct and have employees sign it and making it visible, when you hire employees, and you're constantly talking about it, you're communicating it frequently, then it makes fraud extremely difficult to rationalize. When they know that other employees are living by the code, that the code is followed, and it's hard to rationalize that everybody's doing it or I deserve it. Right? To give an example, the book of Hormel Foods Code of Conduct is extremely lengthy, that one, and just having a code of conduct itself doesn't mean that you've discouraged fraud. It has to go along with the positive work environment, because Enron had an award-winning code of conduct, but nobody was following it because they didn't create a work environment where the tone was that you follow the rules. The tone was that you do anything to increase the share price at all costs. Right? So it doesn't matter that the code of conduct was there. It has to be communicated by management, and management's got to create the expectation and the example. The open door policy, like I said, allows employees who are frustrated because maybe they have this non-shareable problem like we talked about. But if you have an easy access policy and an open door, maybe people are more likely to share some of their concerns, which reduces pressure and reduces the rationalizations that people can make to commit fraud. Right? So it created that positive work environment. Like, my boss listens to me. I feel ownership in this company. They treated me well, and I don't want to let them down. Right? So to the extent that you can create that environment, you've hired honest employees anyway. You're helping keep honest people honest because they're able to relieve their frustrations, because if they have concerns, they can talk to their boss. Even if they have non-shareable problems, perhaps they might not share their specific problems, but they can share their frustrations and concerns, and they feel like management will listen to them, and they don't want to let management down by stealing. Right? There's other things that create negative work environments, like having inadequate pay, not recognizing employees who perform well. If there's inequalities in the organization, so you don't have a clear job structure, and some people are shirking and other people are having to pick up the slack, and they're not being recognized for that, and their compensation is the same as people who are slacking, that creates a negative work environment, and it creates problems, right? Or inadequate expense accounts. So you're expecting employees to travel on their own dime, to do work for you. They get frustrated, and they're more likely to rationalize theft. So creating that positive work environment by management listening to employees, having a clear job structure, recognizing people who are performing, and pay, quite frankly, compensating your higher performers, creates incentive to be a high performer, right? Not setting up necessarily competition among your employees, but recognizing people who are putting in overtime and doing a good job. Sets the tone that you value people who work hard, and like I said, not necessarily setting up competition among employees, but recognizing people when they go above and beyond the call of duty. Sets a positive tone and makes rationalization, more difficult to do. The other thing that small companies it's difficult to do is create an employee assistance program, but for large companies who have the resources, right, that helps. When companies feel pressure because they have this non-shareable problem, like Cressy explained, maybe they have substance abuse or a gambling habit, maybe they have money management problems, and they can take that to an employee assistance program and talk to maybe somebody that's not their boss, but is paid to listen to employees and provide counseling. And they get the counseling that they need before things get too bad and they have to commit fraud. So to the extent that you can set up an employee assistance program to help relieve the pressure, outside pressures that individuals feel is extremely helpful. And they can, like I said, provide support, related to team building, coaching, conflict resolution if they're having problems with other employees. Provide just general counseling, whether it's marital counseling or counseling for alcohol addictions or gambling addictions or other things. It's extremely helpful because then people can get the help that they need without feeling like they need to lash out or steal from the employer. Right? And so we've talked about these ways to create a culture of honesty, openness, and assistance. And this is basically how it's accomplished. So, we talked about hiring honest employees and how to do that, creating this positive work environment, and potentially provide an employee assistance program. So all these things are helpful to help reduce pressure and rationalization to commit fraud. The ways that you eliminate opportunities is we're going to talk about each one of these. Having a good internal control process, we've talked about that already. But discouraging collusion, monitoring employees, and provide a whistleblowing system, and then create the expectation of punishment is a big one, and then conducting proactive auditing. So we'll talk about each one of these. But we've talked about internal controls in the past. Having good segregation of duties, right? And good authorizations, physical controls, independent checks, and documentation are all the elements of good internal control system. And what you do is you identify what your risks are at the organization. So if your inventory is extremely valuable, and it's fairly easy to steal because maybe it's small, maybe it's like you're at Dell Computer and it's pretty easy to steal their laptops because you can conceal laptops, they're portable. Well, if that's the case, then that's a risk, the theft of inventory. So what could you do? Well, you put controls in place. You'd have good physical controls, so you're going to have alarms and physical locks on the warehouse, where you're going to separate duties between people who have custody of the warehouse versus people who have access to accounting. And you separate those two functions, not just on paper, but also physically. So accountants can't get into the warehouse, and the folks in the warehouse can't get into accounting, right, to get into change the records, to potentially cover up a theft by increasing scrap and decreasing inventory. So what you do is you assess the risks, and then you put the controls in place that help mitigate those risks. Right? If you assess a risk that people may be able to steal customer checks when they're mailed to the company, so you have two people open the mail, right? You separate the folks from opening the mail from accounting. So the people who open the mail, they write down the checks that have been received. They give them to somebody else to deposit in the bank, and they forward the remittance advices to accounts receivable, a separate person, a good segregation there, and somebody else updates the customer's accounts. So you identify what the risks are in your organization, and then you put the controls in place that'll mitigate those risks. And we spent a lot of time talking about internal controls already. And the Committee of Sponsoring Organizations, the COSO, everybody uses their framework. So the COSO internal control framework is the framework by which your auditors, your external auditors, are going to evaluate the quality of your internal control system. Because of Sarbanes-Oxley, your auditors not only have to give an opinion on their financial statements, they also have to give an opinion on the quality of your internal controls. right? So their framework says that the first part is having a good control environment, and that's the tone that management sets about how internal controls must be followed. And then the other part is having a good risk assessment process where you've identified like inventory that's a big risk of theft, and then you put controls in place. The control activities are the actual controls, whether it's the alarms you have in place. If for goods that are received, you'll have somebody who actually has to count those goods, write them down on a receiving report. Maybe have two people count the goods that are received. So those are the actual activities that you put in place. And then you want to have good information and communication systems. So when you hire new employees in the warehouse, they know that their responsibility, because you've trained them when they came in, is to count inventory when it comes in, to fill out a receiving report. Maybe two people have to count the inventory at the same time. Right? And then you have a good internal control process who goes up and follows. If they see that employees are not counting goods as they're being received, then they recognize that it's an internal control that's not being followed, and they provide the appropriate training so that it is. So COSO explains that the good control framework starts with the control environment, the tone that management sets. Whether you have good risk assessment, you identify where your risks are and put good controls in place. The control activities are the segregation of duties, are the physical controls, those things that the controls that are in place. And good communication and information is communicating to all your employees what the controls are, and how they're to be followed, and then the process of monitoring is an internal audit that's following up to make sure that the controls are actually being followed. And when we think about controls, you can think about it two ways. There's preventive controls like segregation of duties, having authorization, having physical safeguards like locks. Then there's detective controls, which is independent checks, and then having an audit trail with documents and records. So obviously, if you have segregation of duties and you have authorization processes in place, then you're going to prevent misstatements from happening or theft from happening at your organization. And if it does happen because internal controls are not foolproof, if you have independent checks, you have bank reconciliations and other things, and you have documents and records such that if something when internal control were to be violated and theft were to happen, there would be documents and records that would either be missing or might provide a red flag that a theft has happened. So there's preventive controls and adaptive controls, and we've spent a lot of time talking about internal controls. The other thing that you can do is to discourage collusion, because there's most frauds, employee theft, are individual. But there are times when individuals at your organization collude with people either within the organization or outside the organization to steal from the company. So like in the case of vendor fraud, the buyer at your company colludes with the vendor, and the vendor sells inferior products and increases the price, and then the individual who's colluding with them gets a kickback. Right? And collusive frauds, the book mentioned, has increased partly because you have single employees responsible for large contracts, for large buying activity, and customers and vendors fearing losses of business. So they collude to keep that business relationship going. So ways to discourage collusion is, on the purchase side, you can have a right to audit clause in the back of your purchase invoices that says, anytime you can go in and audit that transaction and look at the prices and compare to price lists and other things to make sure that the price hasn't been, escalating. And the other thing you can do is send letters to your vendors and basically say, here's our policy related to collusion. Here's our pricing policy. If you do any of these things, we consider that to be fraud. Right? And sending letters to vendors helps them recognize that, these maybe the buyer is the one who approached them about a potential kickback scheme, and now they're reading that this scheme that they were offering actually violates the company's policy. Maybe they recognize that, hey, we don't want to get involved in this, especially when they have a right to audit clause. We could get in a lot of trouble. So having this right to audit clause on the back of their invoices, and sending letters to vendors saying, hey, this is our internal control policy. If you hear any of our buyers making overtures towards the potential kickbacks, report it to us. And that helps discourage collusion. we've talked about monitoring employees. Now, Sarbanes-Oxley requires that all public companies have a whistleblower system. And we know that's important because basically a third of all frauds are detected through tips. And one of the best ways to get tips is to have a good whistleblower program in place. And not only U.S. companies, but government agencies have to have whistleblower systems in place. And to be a good whistleblowing system, it needs to be anonymous so that the employee feels like they can blow the whistle and they're not going to get flack from the company and blowback for them having committed the fraud and get fired because they blew the whistle on their bosses. Right? So it's got to be able to be anonymous. It has to be independent. So the people that you blow the whistle to are not going to be under the jurisdiction of potentially people you're blowing the whistle on. So if you have your whistleblowing operations within HR, and HR is under the direction of the controller, for example, then it's unlikely you're going to be able to blow the whistle on the controller who's also committing a financial statement fraud. So ideally, you have a third party who manages your whistleblower system. So you'd call up a third party anonymously, tell them what you know, and then they report that information to the company, keeping the employee's information anonymous. And so the more independent that the whistleblower organization can be from the company itself, the better. And it has to be accessible, right? The employees have to know where they can blow the whistle. You know, that needs to be publicized throughout the firm, and they have to feel like they can do it at any time. So not only does it have to be anonymous and independent, but it also has to be obvious to employees that how to do it and they feel comfortable doing it. And then obviously following up. I mean, if somebody blows the whistle, and just because somebody blows the whistle doesn't mean that they're credible. They may blow the whistle because they were dating somebody at the firm and they broke up with them and now they're mad and they want to get back at them. So you never know why somebody blows the whistle, and the information that may not be accurate. But if somebody blows the whistle and you don't do any follow-up and there's no resolution to their tip or complaint, then that'll get communicated to others in the organization, and others in the organization will be less likely to blow the whistle because it's like nobody follows up. It's like having a suggestion box and you put suggestions in the box and then you look at it, and it looks like it's never been emptied and nobody's even looked at in your suggestions, and you're gonna quit using it. It's the same thing with the whistleblower system. If there's no follow-up when somebody does blow the whistle, that'll get communicated pretty quickly, and you have a less effective whistleblowing system. And they give an example of Toshiba, who introduced a whistleblowing system, and how effective it's been. The biggest way to deter fraud, though, is creating that expectation that they'll get caught and an expectation of punishment. So that's the biggest way to get people to commit fraud. And the way you do that is setting the tone, like we talked about earlier, that if you do something dishonest, we will punish you, right? And it creates a fair punishment. And if you've done it before, then people expect that you'll do it again, right? And real punishment is not just firing people. It's having people have to tell their family members that they were dishonest, that they're actually being prosecuted with criminal behavior. All right, so just filing people, they can sort of explain that way to family members that, hey, I got laid off, whatever, this and that, it's a bad time. But if they have to actually tell their friends and their family that not only did I get laid off or I got fired, there's a criminal investigation into my actions at the company, and that creates the biggest deterrent. So a strong prosecution policy that's publicized, lets employees know that dishonest acts will be punished, creates that fear of punishment. And it's not necessarily a bad fear, because most people at the organization are honest individuals who want to do the right thing. So they don't want other people to cheat. And it's just like in a classroom setting. Most people in the classroom are honest, so they want a strong punishment for cheaters because they want the cheaters out of the class, because they don't want to have to compete against cheaters, because then it puts pressure on them to cheat, right? So creating that expectation that those who are dishonest will be punished is good for honest employees. That's what they want. And it sets the proper tone at your organization, and it makes it difficult to rationalize bad behavior because people who do it do get punished. It's not like they get away with it, so it must be acceptable. and it helps keep honest employees honest, which is what you want. And then we're going to spend a good part of our time talking about proactive fraud auditing, and especially when we get into data-driven fraud detection. But it's important to be proactive, right? And first of all, you can have internal audit. They don't have to wait until there's predication for fraud. They can identify where their fraud risk exposures are. And if they see that nobody's counting inventory when it comes in, so they don't know the quality of their inventory, then potentially there's a kickback scheme, because maybe companies are sending inferior products and nobody's inspecting it when it comes in. And so maybe this is tangential to a kickback scheme, but it might be a red flag that, hey, maybe we should start inspecting items when they come in the door for quality, because if somebody is going to provide a kickback scheme to some of our vendors, it's going to provide incentive for vendors to send them lower quality products. Right? And so if you see potential weaknesses in internal controls, that helps you identify what the fraud risk may be. Then you can test, okay, if I see this weakness in internal control, has it been exploited? Right? Is there a potential kickback scheme because they're sending us inferior products? Well, we can look for large prices increases from certain vendors for certain products. And we can be proactive in looking for other symptoms that might indicate fraud. And so as we identify weaknesses in the internal controls, we can then identify red flags if those weaknesses have already been exploited, and what to look for in the case of fraud. Right? And so then what we do is, if we see multiple red flags, and then that does lead to predication, and then we can build an audit program to actually look for schemes and additional evidence that individuals are indeed committing fraud. And then if we see additional red flags, then we start a full-fledged fraud audit and we investigate those fraud symptoms. So we're going to spend a lot of time talking about how to be proactive in a fraud audit, but this is sort of an overview of these things. The Statement of Auditing Standard number 99, which is consideration of fraud in the financial statement audit. And it was interesting because it originally came out as Statement of Auditing Standard 82, that came out when I was auditing. And in the past, auditors didn't really view themselves as being responsible for committing fraud, because they viewed their job as the auditor was to make sure they were following GAAP. And their job was, we ask the client to give us all their documents and records, they give them to us, and then we evaluate those documents and records to determine if they're actually following GAAP. And then if they're not following GAAP, then we point out situations where they didn't follow GAAP, and then we have them fix it. They didn't view their job as, well, if management's lying to us and they don't give us all their documents and records, or they cover things up, that's not our responsibility. We're not actually we can't be held responsible for when management lies to us. Because the assumption in the audit when they hired us was that they were going to give us everything. In fact, we had them sign a management representation letter that said they were giving us everything, and that they're not aware of any fraud. And therefore, we take all their documents and records that they gave us, we assume it's everything, and we just determine if they're following GAAP. But the public didn't think that's what auditors were doing. They thought auditors were actually fraud detectors. And so when there was fraud at an organization, they would sue the auditor. So the auditor said, okay, well, let's be responsible. I guess we need to recognize that we are responsible for identifying fraud. So they came out with SAS 82, which later became 99, that said, you actually have to consider the risk that the company's committing fraud. And so what we would do is we had a bunch of red flags, and we would give the client a checklist and say, here's all these red flags of potential for fraud. Do you have any of these? And then they would say no, and we would say fraud risk was low. And so we said we fulfilled our requirements related to SAS 82, fraud risk was low, and then we would continue to do the same audit we've always done. Well, that happened, 82 came out in probably 1997 or 1998 when I was auditing. And that wasn't working, because then Enron and WorldCom and Adelphia and HealthSouth and Tyco and all these other frauds came out. They said, well, just because auditors are assessing fraud risk now doesn't necessarily mean that they're doing anything to catch it. So they changed the auditing standard to SAS 99 that said, not only do you have to consider fraud, here are the things that you need to look for. And when you start when you start an audit, you need to brainstorm on the potential ways the company, that individual client, could be committing fraud. So everybody in the audit team, anybody else who's associated with that client, like the tax partner, the consulting partners, they need to sit down and assess whether the company could be committing fraud, and if so, how would they do it? And then once you've identified the method by which a company could be committing fraud, so let's say they're manufacturer and they have a lot of inventory, well, maybe they're committing overstatement of inventory and understate their cost of goods sold. So if that's the fraud scheme that you've identified that's possible at that client, then you would design tests, audit procedures that would detect that fraud, that type of fraud that you've already brainstormed could happen at that organization. So the purpose of SAS 99 was to not only assess fraud risk, but also to change your audit program to be unpredictable and to design tests that actually could predict fraud. And what, like through my research and research of others, have found that if they do consider fraud up front, then auditors are much more likely when they evaluate evidence later on to consider fraud as a possibility for some of the audit procedures that they perform when they find discrepancies and other concerns, that they actually consider fraud as a potential for that, and they're more likely to uncover fraud if they do that. So the purpose of SAS 99 was to have this brainstorming session to create a good fraud risk assessment, identify the schemes that could potentially be happening, and then develop audit tests to detect for fraud. They're hoping that would be more effective. And so to prevent fraud, I had a summary here, and if you got this Venn diagram, if you can create a culture of honesty, openness, and assistance, and then on the other side, eliminate fraud opportunities through these various activities, hopefully it intersects in an area where fraud is extremely unlikely within an organization. And to prevent fraud and actually catch fraud, you have to follow the pattern here, which is there's a fraud incident, you investigate it. If you find evidence of fraud, you take action, and then there's a resolution. So maybe you've taken action where you've formed a criminal investigation, you've prosecuted the individual, they've been fired, they've gone to jail, right, and you fixed it. So whenever there's a fraud or predication of a fraud, you need to investigate, take action, and resolve it, right, in a firm manner, so then it increases that perception of not only detection but also punishment for employees, and then it makes fraud less likely. And then some suggestions in the preventing fraud model, right, is the tone at the top, right, education and training, identifying the risks, reporting and monitoring, being proactive, and then following up, right, doing an investigation and following up. So we're going to continue to talk about these things over the next several chapters as they relate to employee fraud, embezzlement, theft.